Thank you so much for joining us on this special Labor Day edition of Bloomberg Daybreak. U.S. markets are closed for the holiday. I'm Nathan Hager. Coming up this hour, with summer all but in the rear-view mirror, what's the outlook for stocks at the end of a volatile year for equities? We have a special roundtable with Lori Calvasina of RBC Capital Markets and Invesco Global Market Strategist Brian Levit. Plus, we look at how retailers are faring with school back in session when we'll speak with Burt Flickinger, Managing Director at Strategic Resource Group. But first, we focus on the economy because September will be a very busy month. On Friday, we get the jobs report for the month of August, and that will be followed by a Fed rate decision September 17th. Let's get a preview with two of our favorites. Wells Fargo senior economist Sarah House is with us, along with Jennifer Lee, senior economist at BMO Capital Markets. What better day than Labor Day to talk about the labor market? Thanks so much for being with us. And of course, we are just a little more than a week out from Fed Chair Jay Powell's comments at Jackson Hole with his view on labor. Here's what the chairman had to say.
Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising.
So, Sarah, I'll start with you. How should we be looking at the labor market right now?
Right. So I agree with Chair Powell that right now it's in balance, but it is a very fragile balance, and we continue to see, I think, demand for workers remain pretty tepid, and so that leaves supply is really the big question mark in terms of whether we can maintain this balance or whether we're going to see the jobs market soften in a way that becomes more concerning.
So, Jennifer, is that your view as well? Is supply the issue when it comes to where things stand in the labor market?
It's sort of both. I hate to sound weak, like a wishy-washy when I'm saying that, but I'm also very curious about demand, just given that we know that businesses have been very hesitant to make any real hiring, firing, decisions on the labor front, just until a lot of this uncertainty over trade and over inflation passes through. And we see that from all the different surveys that are out there. And this is why I think it's also super important to, sort of look at this with a bit of more of a skeptical eye than usual, just given all the hoopla over the report over the last month. But look at all the different surveys that are coming out including job openings and the different ISMs, just to see what the purchasing managers are saying about hiring. So I think I'm kind of leaning toward demand as well.
Interesting that you bring up the hoopla around last month's report. Of course, this is going to be the first non-farm payrolls report since the firing of the head of the Bureau of Labor Statistics. It does raise the question, Sarah, about whether there is going to be some trust issue with this report coming out later on this week.
I think there certainly could be, and I think this could challenge the response rates even further. So the declining trend in at least the first response to the CES survey has been behind why we're getting such large monthly revisions. If you look at by the third release, it's getting back up to a little over 90% where it has been. But if you have public authorities saying that this data can't be trusted, that just decreases the incentive for businesses to respond. And so I think it could actually amplify some of the volatility and scope of revisions that we see.
What's your trust level in the data right now, Jen?
Ever since COVID, we know that the response rates have been lower than usual, but revisions in general are not new. And I'm going to refer to the latest GDP report for the second quarter. The headline wasn't changed too much, but the details, it was very interesting to see all the details and all the revisions to business investment. So, that is going to raise some questions about the quality of the data, but I think it just has to do with, how many people we have on staff to calculate and collect all these surveys responses and put them through. And of course, again, having the survey responders taking a little bit longer to respond, just sort of puts a lot of questions into the data. So this is why, again, we have to look at all of the data around jobs, all the data around the economy to make, some better, I guess, calls on where we see growth.
Well, let's talk about some of that data that you all are looking at. Sarah, what's going into your forecast when it comes to how you see the labor market right now?
Yeah, so I'm looking at a lot of the demand indicators, like some of the PMIs that Jen mentioned, so the ISM, but I also like to look at the regional Fed survey PMIs, and what they were showing over the past couple of months is that The degree of hiring remains very weak. They're kind of hovering around contraction territory, just right between positive and negative. But they haven't really gotten worse. Same thing if you look at the NFIB Small Business Hiring Plans Index. They've actually picked up a little bit since the spring, kind of right around the Liberation Day. And so I think when you look at that, the fact that layoffs remain very low, if you're looking at initial claims, that there actually seems to be maybe some hints of stability over the past month or two in terms of the hiring backdrop. And so I think, again, lower supply remains a challenge for payroll growth. At least on the demand side, it doesn't look like conditions have gotten materially worse over the past month or two.
And in terms of your outlook, Jen, what are you looking at? Are we starting to see signs that policy changes, immigration, trade, artificial intelligence are starting to have an impact on the labor market?
I think they are. And by the way, I just wanted to add to Sarah's list, the Conference Board survey. I used to get super excited when I would be looking at the number of people that were raising their hands when they're being asked, are jobs hard to get or are jobs plentiful? And we've sort of noticed a little bit more of a deterioration on that front. So again, sort of to what Sarah was saying, it hasn't changed too much, but we're starting to see some softness building up. And certainly, I think all these policies are having an impact, certainly on the deportation front, when we have the largest deportation effort ever. And you look at the sectors that are super reliant on these workers, agriculture is the biggest one, with 50% of the workers being undocumented, and construction is like 20%, leisure and hospitality about 10%. So I think it's having a big impact on those particular sectors, and consequently, we should be, although we haven't seen too much of, an impact on inflation.
We're speaking with Jennifer Lee, senior economist at BMO Capital Markets, as well as Wells Fargo senior economist Sarah House, as we look ahead to the jobs report coming out later this week. Of course, a Fed decision later on this month. Sarah, how important is this jobs report going to be when it comes to that Fed decision?
I think even more than inflation, this is the key report for whether the committee decides to walk through the door for a September rate cut that Powell opened in his Jackson Hole speech. So I think the committee broadly expects some increase in inflation around tariffs. I think the base case is still that it doesn't spill over into services. Inflation expectations remain anchored, even though they're aware of the risk that might not happen. So really it comes down to, is the jobs market hanging in there, or is there enough weakening where the Fed does need to move a little bit more towards a neutral posture? So the committee still thinks that policy is at least modestly restrictive to varying degrees, depending on what Fed official. But I think it really comes down to, are we seeing signs of the labor market weakening to the point where the Fed really needs to step in and help cushion the maximum employment side of the mandate?
You have to wonder, Jen, when we did see that second quarter GDP number revised a little bit higher, whether policy is as restrictive as some Fed voters have said it is. What's your view on that?
So it's interesting. When I first saw the second quarter GDP report, and then I thought, and some of the details, especially on the business investment front, sort of tongue in cheek, my first comment was, and we're cutting because it shows that the U.S. economy is still resilient, is still holding up. And again, as Sarah pointed out, it's all going to come down to this jobs report, because as Fed Chair Powell said, that the downside risk is coming from jobs. So there's going to be so much attention paid on that August payroll report. And by the way, I also am very curious to see how revisions are going to go.
Yeah.
Very, very curious.
Yeah. It was all about the revisions last time around. Is that still an issue for you, Sarah, whether we do continue to see these numbers sort of get revised downward, another surprise once again, potentially?
I think increasingly we're looking at what is the 3-month average rate of employment, and really looking at the jobs report inclusive of the net revisions, just given that bias we've had towards downward revisions over the past couple of years, where it's just not as much about the most recent print anymore, just given that low initial response rate. But again, just the credibility of the data seems to be holding up once if you allow businesses a little bit more time to get in. So we'll certainly be paying heavily a lot of attention to the net revisions, as I think a lot of market participants will be.
And of course, it goes without saying that the Federal Reserve is under a lot of pressure to cut interest rates. It seems like every other day President Trump is calling for that. Jen, how much does that weigh on what we could get later this month?
That's a tough question and a tough thing for me to answer. I think everyone on the Fed is, everyone's human, so I'm sure that this is sort of weighing in the back of their heads. But everyone is a professional, and everyone knows that they are going to do what they feel is best for the economy. And some feel that lower rates are definitely the way to go, and they should have been cutting earlier. And I'm thinking of a couple of Fed voters in particular. But not everybody's on board. I believe it was Boston's Collins who said that wasn't a done deal just yet. So, again, it's all going to come back down to jobs and what happens with the headline, with the jobless rate, with the averages, with the revisions. Also, I also noted that the average duration of unemployment in terms of weeks has been picking up over the last couple of months as well, and now they're at the highest since 2022. So, again, it's going to be all about the headline numbers, but as well the data, the revisions, and the details behind the data.
How much pressure do you think the Fed is under when it comes to politics, Sarah?
I mean, I think certainly more than we've seen in decades. I think just the public nature of it is pretty obvious here, and I think what that means for the path of rates ahead is I think it's going to put some questions over the cutting that we are likely to see. So if you think of tariffs in the classic sense of it's a one-time increase in prices, it shouldn't lead to persistent inflation. Policy is still above estimates of neutral. I think that does support cutting, but I think there's going to understandably be some questions over what is the committee's motivation to the extent that we do see cuts later. So it's a cloud.
Yeah, and I think it's safe to say it's probably going to be one of the closest watched Fed decisions coming up later this month, as probably all of them are going to be for quite some time. Thanks to both of you for joining us on this Labor Day. That was Sarah House, senior economist at Wells Fargo, and BMO Capital Market senior economist Jennifer Lee. And coming up next, we'll turn from the economy to the stock market with Lori Calvasina of RBC Capital Markets and Brian Levit at Invesco. That's as this special Labor Day edition of Bloomberg Daybreak continues. It's 20 minutes past the hour. I'm Nathan Hager, and this is Bloomberg. Thank you so much for joining us for this special edition of Bloomberg Daybreak. U.S. markets are closed for Labor Day. I'm Nathan Hager, and we turn now from the future of the economy to the outlook for the stock market for the rest of the year. And what a year this has been. Stocks soared to record highs in August, but it certainly wasn't a smooth ride for investors. Of course, we remember the sell-off in April on the tariff concerns. So to look at what's ahead as we round out this year, we have another special roundtable for you. Joining us now, Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets, and Invesco global market strategist Brian Levit. It is great to have both of you with us today. And Lori, I'll start with you. Have you seen a year like this before?
It's a great question, Nathan. Thanks for having me, by the way. And look, I've been in equity strategy in some capacity or another for more than 25 years now. I've never seen a year like this. And to be honest, that's something we sort of addressed in our year ahead outlook, way back last November, was that it was, we thought forecasting was going to be, a little bit more difficult than usual this year. There have been a lot of twists and turns. I think our approach has just been to stay focused on the data and call it like we see it.
Brian, how do you map out a rest of the year after all that we've seen in the last 8 months?
The first thing I would say is I don't think that it's been so out of the ordinary, simply from the perspective of, the market had been up quite a bit. What tends to derail that is policy uncertainty. And so we got that. As we move towards more clarity, both on trade policy and with the expectation of what the Federal Reserve is going to do, the markets recovered, and they recovered pretty quickly. So it's not entirely out of the ordinary. All the while, growth slowing in the U.S., but still resilient. Inflation expectations up a bit, but still generally stable enough. So all of that's a good backdrop for markets. I would expect that the markets end the year higher on a couple of things. One is going to be more Fed easing, and a continuation of this easing cycle, which should support broader parts of the market. And already you're seeing a broadening of the U.S. equity market, certainly from where we were in 2024.
I have a feeling I might be hearing a bit of a contrasting view from you, Lori, after looking at some of your latest notes. I know you've got a year-end price target on the S&P 500, a little bit below where things sit right now at 62.50. Where's your conviction right now?
Yeah, and I think where I'm a bit differentiated right now, to be honest, Nathan, is we feel pretty neutral heading into the balance of the year. Now, we do tend to view our price target as a compass, not a GPS. So we always tell people, don't get overly precise. This is a signaling mechanism for how we feel about the path of stocks from here. And I would tell you that kind of post-Labor Day, we have been concerned that we could be set up for a little bit of a period of chop. And there are a few reasons for that. One is that seasonally, if you go back and you look at September and October during the past 5 years, September has been down 4 out of 5, and I think October has been down 3 out of 5. So, it hasn't been 100%, but this is a period of the year when we tend to experience some choppiness. Secondly, if you look at valuation levels, whether you're looking at S&P market cap weighted, whether you're looking at the NASDAQ 100, which has been, kind of everybody's favorite growth trade, or if you look at even the top 10 market cap names in the S&P 500, which is a really good proxy for the AI engine, we've been trading close to levels, that have essentially been in line with where we peaked out most recently. And the market has been, we've been kind of creeping up to these new highs in August, but have really had a difficult time punching through them with any certainty. So, I think that we are seeing some valuation pressure start to seep in. And frankly, I don't disagree with Brian on the idea that the Fed cuts provide a tailwind, but I've been getting an earful from clients about this for the past 3 months. So we do think to some extent, a lot of this has already been pre-baked into stocks.
I'm glad you mentioned valuations because, whenever we see these lofty levels, record after record broken over the last several months, there has been the question about whether this market is heading into an asset bubble. So I put that question to you, Brian. Where do you sit when it comes to where this market is valued right now?
The S&P 500 index is overvalued compared to certainly its long-term history, but even its more intermediate-term history, which probably makes more sense to look at given how the economy and the markets have evolved. So yes, you are trading at an elevated valuation. Reality, as everyone knows, is that valuations are not timing tools. You need to have some catalyst one way or the other to either see valuations improve or valuations correct. What's more interesting, perhaps, is if you look beyond the S&P 500, which, of course, is just one way of gaining exposure to the market, the valuations are not all that excessive. I tend to focus on the median stock in that index or even an equal weight index where valuations are certainly not that excessive. So it is concentrated, to Lori's point, in the top names. Also, if you look mid-cap, if you look Europe, if you look emerging markets, you're also dealing with pretty reasonable valuations. So it is primarily an S&P or NASDAQ story, and that's a call on the AI trade rather than the broader market. As far as markets hitting new highs, that's fairly common. If you go back to 1957, the stock market has hit a new high once every 2 weeks. And actually, you've been better off investing historically on days when the market hit a new high than on just any random days. So I'd advise investors not to be concerned or wary simply because markets that are at all-time highs. You want to think about how market cycles end. Market cycles typically end with a lot of leverage, policy tightening, bankers tightening lending standards, credit spreads blowing out. None of that is happening right now.
We're speaking with Brian Levit. He is a global market strategist at Invesco, along with Lori Calvasina, the head of U.S. equity strategy at RBC Capital Markets. Glad Brian brought up the idea of small to mid cap stocks as well, because of course there is a lot of attention, a lot of focus on the S&P 500. How are you viewing some of those broader names in the stock market right now, Lori?
So look, I'm a former small cap strategist. So I always enjoy talking about this space. And I have seen, if I look across the street, sort of a general impulse to get long the small caps or to go overweight. And I want to say, we're certainly not bearish here, but we think for longer term investors, we like more of a neutral stance as opposed to, kind of recommending an overweight at this point in time. And I think that, what I feel like I can really see pretty clearly in my client conversations is that the excitement over the Fed is something that I think is generating a lot of interest in the small cap space. And, as Brian mentioned, certain areas like small cap, if you kind of get away from those biggest market cap names in the S&P 500, you've got much more reasonable valuations. So as I look at, kind of the onset of cuts coming, exactly when I suppose is still up for some debate at least. But we do understand the impulse for a trade there, right? And we did see in August small caps finally broke out of their range that they had sort of been pinned in when you look at the Russell relative to the S&P. So we did have kind of a big breakout after Jackson Hole. And I think you want to respect that momentum and the interest in the rates trade. The problem is that if I look since the end of 2023, whenever the market dials up Fed dovishness, we see the hedge fund community kind of pile into small caps in a very short-term oriented way. And then that trade tends to fizzle out. So, when I'm talking to my small cap PM clients or longer term investors, I really want to understand the risk of it fizzling out again. And I think the reason it keeps fizzling out is that the economic backdrop is just not strong enough to sustain a longer term outperformance trade. I don't think the Fed alone is enough. What we typically see, when the Fed, is cutting, it's around a recession. And that's when you get the big long-term small cap outperformance cycles. If you look to the mid-90s adjustments cuts that happened, you only got short-term small cap outperformance. What do we see in that economic backdrop right now? Well, my economists are looking for 1.3% GDP this year, in real terms, 1.6% next year. And consensus has been very similar, maybe a touch higher, but still stuck in that 1% to 2% range. Average GDP is around 2.5%. And we tend to see small caps really only sustain outperformance trades when you're above that 2.5% mark. Other indicators you could look at economically would be non-farm payrolls. If you're in an accelerating job growth environment, that's good for small relative to large, but stagnant job growth or decelerating job growth typically is not. And another good barometer is ISM manufacturing. It's been stuck in a rut for a while now. You really want to focus on the direction of travel there. When that tends to move up, small caps have an outperformance cycle relative to large that can be sustained. But that one has just, we watch it every month hoping it's going to break out, and it's just stuck in a rut, which I think is a testament to some of the kind of mixed vibes that are still out there right now.
Well, I guess there's still a debate about whether the economy is headed into a slowdown. We've got GDP indicators showing that we're still above 3%, at least as far as the second quarter goes. So, Brian, what are you thinking as far as whether the economy is headed into a slowdown, and whether this is all about the market expecting that we're going to see rate cuts that can continue to keep this rally going?
I think it's pretty clear that we're heading into a slowdown. If you look at leading indicators of the U.S. economy, to Lori's point, they're not doing much. They're not doing enough to suggest that you're going to see a significant breakout in U.S. economic activity. And part of that has to do with the tariffs, where we know that that's going to slow some activity. We know that's going to slow some consumerism. And it's in essence why the Federal Reserve is looking to lower rates. The risk to that call is, of course, if inflation expectations begin to break out and the Fed has to back off of it. So I don't think that's going to be the case. My expectation is the economy will slow. That slowdown in the economy will be viewed favorably by the market because a little bit of the bad news is good news mentality, where the Federal Reserve will be able to cut rates. I agree with Lori's point that in order for these other more reasonably valued parts of the market to outperform, you're going to need a catalyst. And right now, looking globally, there's just not a lot of pickup in activity. And in essence, when there's not a lot of leading indicators pointing higher, you need a policy response. So hopefully we see more of that out of China, more of that out of the United States. And the expectation, the hope is that you start to see leading indicators recover as you move out into 2026. For now, it is leading indicators that are pointing to below trend growth and maybe even decelerating a little bit. And I almost hate to say it, but in that environment, that still tends to favor higher quality, mega cap, growthier type businesses. And that's what's been outperforming again recently.
Yeah, it certainly has, if not for the last few months. Thank you for this, both of you, for joining us on this special Labor Day Bloomberg Daybreak. That is Brian Levit, Global Market Strategist at Invesco, along with Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. And coming up next, we're going to focus in on retail, now that school's back in session. Burt Flickinger joins us from Strategic Resource Group. It says this special Labor Day edition of Bloomberg Daybreak continues. It's 38 minutes past the hour. I'm Nathan Hager, and this is Bloomberg. Thank you so much for joining us on this special edition of Bloomberg Daybreak. U.S. markets are closed for the Labor Day holiday. I'm Nathan Hager. School's back in session, and with tariffs impacting profits, we thought we'd wrap up this Daybreak special with a focus on retailers. And who better to do that with than Burt Flickinger, Managing Director at Strategic Resource Group. Great to have you with us on this holiday edition, Burt. And, if the holidays, Christmas, New Year's, or the Super Bowl for retail, back to school season's got to be the All-Star game. So how's it looking?
It's looking, Nathan, that Labor Day is going to be the turning point for the entire year for calendar 2025, Labor Day through New Year's Day holidays, and then into calendar year 26. Why is that important? The reason is 70% of Americans are living paycheck to paycheck. And Nathan, for the first time in U.S. history, you look on the Bloomberg terminal, all 12 monthly expenditure areas are up. And that's the first time that's ever happened. So healthcare, food, utilities, phone, taxes, housing, insurance, clothes and shoes, debt, transportation, education, entertainment. So America's really cash squeezed. But at the same time, there's a lot of retail doing well, as reported on Bloomberg Terminal and Bloomberg Around the Clock between Bloomberg Europe, Asia, and America. So there's good news and a lot of bright spots in retail, despite some cloud cover coming around the corner on the horizon.
Well, let's talk about some of that good news. I'm guessing, based on what you're saying, that we're seeing a lot of that good news in sort of the lower-end retail space. Is that what I'm hearing?
Definitely lower-end. Price impact defined as Costco, all the Winco, Lidl, Trader Joe's, doing exceptionally well, putting up record numbers. The irony, Nathan, is Amazon is not making money from Whole Foods and Amazon Fresh and bricks and mortar retail. So Amazon's the powerhouse and number one retailer worldwide, and Amazon online and Amazon overall is doing better than ever before, but retail's a real Achilles heel. Department stores, as you've reported well for a long time, department stores are struggling, yet there's a big bright spot in Dillard's capitalizing on Penny, Macy's, Belk, and others, and especially Kohl's, which is really struggling. Target, which is the big surprise. Last year, you reported the stock price of Target at over 230. It's struggling to stay above 100 now, and Target's keeping the people who caused the problems to solve the problems. Where I think, Nathan, your and my big concern is Target's been going for 65 years. 80 to 90% of all Target purchase decisions are made or influenced by women, and Target is yet to have a woman CEO, and Target has the best women executives in the business. So that's a Socratic question we have to ask, especially when you consider the best and the brightest women. Carol Meyerowitz at TJX, to your point, spectacular results. Beth Ford turned around Land O'Lakes Co-op, great results. Peggy Davies turning around the Private Label Manufacturers Association, great results. So the women are outperforming the men, but women are only 15% of the CEOs. And you get more women CEOs, especially in the department and specialty stores. You'll have a real retail renaissance in Requiem.
You could talk about so many factors that go into the challenges that we've seen from some of those names you just mentioned, like Target, like Kohl's. They've had the CEO issues as well, along with potential impact of tariffs, politics as well. I mean, what are some of the biggest issues that are holding back some of these companies that used to dominate for so long?
Nathan, our biggest concern at Strategic Resource Group, and you see it on the Bloomberg terminal every day, is everything from screwworms to tariffs. So screwworms can impair and impede the livestock and affect humans, pets, cattle, and only 20% of the sterile flies to combat the disease are produced. So this has been a catastrophe in Mexico, Central America, South America, now moving towards the Texas border. Meat prices are limit high every day in the Chicago commodity markets, as reported by Bloomberg. Farmers are getting the lowest crop prices on a cash per bushel basis in 15 years. So we should have the lowest meat prices in history. Yet because of the screwworm, the African swine flu in Asia, and the avian high pathogen bird flu, protein is the highest price in history, and the farmers are going out of business at record levels. So for the administration, last administration and this administration hasn't been prepared enough, in my professional informed opinion, on the screwworm and the tariffs. To your point, Nathan, that's an artificial inflation. So we not only have the highest prices in history going into Labor Day weekend, we're going to have higher prices for holidays. So toys will be the highest prices in history for Christmas, Hanukkah, Kwanzaa, as will candy and confection. And Bloomberg reported earlier that because of the 50% tariffs coming out of Brazil, coffee and wheat and cattle are going to be at all-time highs coming out of those countries too.
We're speaking with Burt Flickinger. He is the managing director of Strategic Resource Group. Given all those factors, Burt, I mean, we've seen over the last few months that despite things like tariffs, like some of these exogenous factors, the consumer has managed to hold up. How much longer do you think the consumer can still hold up against all this?
Consumers holding up, Nathan, and interestingly, because the consumers are outsmarting the stores, we're writing a book, The Explosive Growth of Private Labels Eclipsing National Brands, for the first time with Peggy Davies' leadership at the Private Label Manufacturers Association. People can save $5,000 a year just on food and beverages buying higher quality, better produced, fresher private label product than they can the national brands, because the national brands, Nathan, have one page in their playbook, including my alma mater, Procter & Gamble, is raise prices some more. Bloomberg reported on the terminal that Smucker's is raising coffee prices for the third time in this calendar year. I mean, come on, give shoppers a break. So consumers are migrating to private labels. So with all the high 12 monthly expenditure costs, if a family of five can save $5,000 a year switching from branded product or private label, which is higher quality, Trader Joe's, Aldi, Costco, Kirkland, Kroger, etc., they're going to be able to balance out their bills and keep spending for gifts and the holidays, and for maybe a few affordable luxuries for the parents and people who were heads of household. So it's not all grim, because private labels revolutionizing the world and raising shoppers' standards of living. And despite all the price gouging, despite all the tariffs, despite all the livestock diseases, private labels saving the day for across America and across the world.
Oh, it's got to be said, there aren't a whole lot of private labels when it comes to some of those gifts that people might be thinking about for their kids and their families heading into the holiday season. What could this mean when it comes to holiday shopping later on into the rest of this year?
Look at Saratoga Springs as an example, Nathan, for Bloomberg, is the vintage stores, which are ubiquitous across the country, whether they're spiritually based stores, Goodwill, Salvation Army, etc., Savers. People are buying pre-owned clothes, well-tailored, $1 to $5 a garment for the cost of a nickel or a penny of what they'd pay on a percent basis at a department store. So Saving on private labels, one piece, saving on clothing and apparel and pre-owned product and all the way to pre-owned cars is a big way to save. And that's the way the shopper's saving itself until food prices come down as we get through these livestock diseases at the end of crop year 2026. And as we get through, hopefully, the crisis created by the administration again of lowering the value of food stamps or SNAP, Supplemental Nutrition Assistance Program, WIC, Women and Infants and Children's Program, which seems absurd at the highest food prices in history to lower the funding for the people most in need for food and beverage to feed families, especially breakfast, which many American consumers are skipping because of the high cost of cereal, milk, and a banana. And it's so important for people's performance at work, and especially even more important for kids' performance in school. So the government really needs to reevaluate the food stamp cuts and the WIC cuts and reinstate them so people can afford to eat and afford to pay their rents and not get evicted from their homes and not lose the leases on their cars.
If we're looking at private labels, though, Burt, what could all this mean when it comes to the returns for some of these companies that in the past have relied on, name brand items to boost their profits into the rest of the year?
You're asking an important point, Nathan. And on the Bloomberg terminal, there are two key metrics. One is that the big top 25 brand manufacturers, Kraft, Kellogg, Coke, Pepsi, Procter, Smuckers, etc., they're selling less hectoliters or less per hundredweight product. So in terms of that, people are being able to afford to eat less and can't afford to buy branded product. With private label, they can afford to feed their families, whether it's shoes, clothes, consumable food and beverage product, and the taste profile, whether it's Wegmans or Weston Loblaw or Tops Markets in Buffalo or Safeway or Kroger or Costco, which is a particularly strong, Aldi, Lidl, Winco, Trader Joe's. The examples are very numerous on the Bloomberg that the private label companies and the price impact companies are dominating. And at Cornell College of Agriculture and Life Sciences, where I teach this in an adjunct executive lecture, they proved through their clinical labs that the private label product is as good or better than the national brands, because since Warren Buffett took over the control of Kraft, there's no real food taste than cheese and Kraft singles. It's all kinds of cheese food, where if you buy Land O'Lakes, you get 100% cheese, or if you buy private label cheese from Crystal Farms, it's 100% cheese. So people live better, live healthier, live longer, and have more productive days at school and at work with private label brands than they will with national brands, which have been diluted with a lot of emulsifiers, fillers from candy and confection, all the way to cheese and ice cream and other top 10 power categories for consumers across America.
All right, lots to consider in the retail space as we head into the rest of this year. Thank you for this, Burt. Really great having you on with us. That was Burt Flickinger, Managing Director at Strategic Resource Group. Thanks as well to RBC Capital Markets, Lori Calvasina, Invesco's Brian Levit, Wells Fargo's Sarah House, and BMO Capital Markets' Jennifer Lee. And thanks, of course, to you as well for listening. I'm Nathan Hager. Stay with us. The day's top stories and global business headlines are coming up right now.